Reliance Industries is the largest public company in India.
Reliance will continue to grow bigger and bigger, like the proverbial banyan tree.
Reliance is going to be the biggest wealth creator in Indian corporate history.
It sits at number 88 on the Fortune 100 among the biggest and most powerful companies on the planet. Such companies are often controlled by boards of directors comprised of investment fund managers and high-powered executives. But in India, the largest company, Reliance Industries, is a family business. Its stock has been the most widely owned in India since the 80s, but the Ambani family has maintained control throughout its history. Reliance is responsible for 3% of Indian GDP and 5% of its tax revenues. Its credit rating is higher than the government's, meaning it can borrow at the lowest cost of capital in India. Reliance is one of the largest energy companies on Earth. It operates over 12,000 retail outlets and is doing over $100 billion in annual revenue. Additionally, it's been one of the best long-term investments of the past century. Its market cap has grown at a 30% compound annual growth rate for the last 46 years. In this video, you'll learn about Reliance Industries' clever origins, how they built the world's largest oil refinery, and the growth opportunities that they're still pursuing. And at the end, we'll answer a simple question. Can anything slow this freight train down? Reliance was founded by Dhirubhai Ambani. And if you want to understand just one thing about him, he was exceptional at spotting opportunities and executing on them. Before returning to India to start his company, Ambani lived in Yemen. In the early 1950s, the country began to experience a currency shortage. Upon investigation, monetary authorities found the source of the problem was a clerk in the city of Aden. That clerk had discovered that Yemeni rials contained more silver than their face value. So he was buying them for British pounds, melting the silver, exchanging that silver for more pounds, and repeating the process. That clerk was Dhirubhai Ambani, and he escaped Aden to return to his native India. There, he founded Reliance with plans to exploit the market in another interesting asset class, import permits. In the late 50s, India's protectionist policy only allowed companies to import raw materials in proportion to their exports. This was intended to encourage manufacturing, but some exporters sold products locally and therefore had excess quota that they did not need. So Ambani bought up the rights to that quota and cornered the market for yarn imports, meaning that he had the power to turn off and on supply as he wished. He had monopolized his first commodity and wanted to expand his margins. So Ambani set up a textile manufacturing facility, vertically integrating from the trade of raw materials to manufacturing the finished products. Next, Ambani persuaded the government to allow him to import polyester filament yarn in proportion to the nylon goods that he exported. Nylon was cheaply available in India, but local polyester filament was 6 times more expensive than it cost when imported. So Ambani set up a closed loop. He'd make nylon clothes from locally sourced materials and sell them abroad, use the import quota to import polyester filament and sell it at home. According to the book The Polyester Prince, Ambani sent money abroad to buy his own products at duty-free ports and then sold them for cheap, gave them away, or even dumped them into the ocean. The entire business was an arbitrage on regulatory semantics. Nylon and polyester filament were exactly the same by the letter of the law, but had distinct prices in the market. Ambani made a small fortune closing the gap. The reason these gaps existed is that mid-20th century India operated more like the Soviet Union than the United States. After gaining independence from Britain in 1947, all the way to 1991, India's heavy state intervention created opportunities that Ambani exploited. Like Cold War Russia, India produced a collection of oligarchs with phenomenal outlier financial outcomes. A meaningful portion of Reliance's company budget would go towards bribing government officials, but the reward was near monopoly-level profits. The elaborate licenses and red tape, known as the license Raj, limited who could set up what type of business. Quite simply, you couldn't be an entrepreneur in India in the 1970s without currying favor from the government. Ambani became adept at this, forging close ties with the aides of Prime Minister Indira Gandhi. Dhirubhai played the system masterfully to produce Reliance's early success, and he would continue to press his advantage for decades. Ambani continued to vertically integrate through the polyester supply chain. In 1977, a new Indian Congress scrapped the regulatory scheme that he had been exploiting. This meant Reliance had to focus on selling its polyester to the Indian market instead of exporting. Ambani created the Vimal polyester suit brand and established a network of Vimal franchises across India to sell products directly to consumers. That same year, Reliance went public. The Indian population piled into the IPO. Reliance stock was listed on the Bombay and Ahmedabad stock exchanges in November of 1977. It issued 2.8 million shares, and over 58,000 small investors from across the country acquired equity in the company. Between 1980 and 1985, the number of Indian shareholders increased from 1 to 4 million. Of these, 1 in 4 became a Reliance shareholder. At the 2017 annual general meeting, Dhirubhai's son, Mukesh Ambani, said a share bought at IPO would have generated a 1,000x return by 2017.
Our turnover has grown from 70 crores in 1977 to over 3,30,000 crores today.
The new investor base also gave Reliance a broader political constituency. Instead of solely paying government regulators with bribes, they could now influence the electorate with dividends. Reliance made a lot of Indian investors wealthy over the intervening 46 years as the stock grew and split repeatedly. Flush with cash, Reliance continued to backwards integrate. Reliance Petrochemicals was launched to make the polyester fibers that fed into the rest of the firm's processes. From 1985 to 1992, the company expanded its capacity for producing polyester yarn by over 145,000 tons per year. It could now manufacture a wide range of petrochemicals, polymers, polyesters, and polyester intermediates. And the growth coincided with another lucky break. In 1991, under a new prime minister, India liberalized. It rolled back its protectionist policies and outlined new strategic objectives, like removing licensing restrictions on most industries, dismantling public sector monopolies, and incentivizing foreign investment. Indian liberalization set Dhirubhai Ambani up for his biggest move yet: Reliance Petroleum. Ambani returned to the stock market to raise more funds for Reliance Petroleum, which would continue the backwards integration of his business. With fresh capital, he built the world's largest petroleum refinery. Jamnagar Refinery was commissioned in July of 1999 with an installed capacity of 668,000 barrels per day. Upon completion, it became the largest refinery and petrochemicals complex ever built from the ground up. At peak construction, the project employed more than 70,000 construction workers. Reliance had worked with top-notch talent, contracting leading EPC firms like Bechtel, UOP, and Foster Wheeler to design and implement the plan. In 2008, the refinery completed an expansion, and today, its current installed capacity is over 1.24 million barrels per day. It was built in Gujarat, India, and its geographic location is really interesting. Gujarat is the westernmost state of India. It boasts a long coastline of over 1,600 kilometers stretching along the Arabian Sea. This positions the refinery as close as possible to the primary source of Indian oil, the Persian Gulf. The complex outputs 1.6% of global capacity and 1/3 of India's total oil consumption. To this day, refining remains the #1 source of Reliance's revenue, responsible for well over $50 billion annually. And building Jamnagar was Dhirubhai's last move. Passed away from a stroke in 2002. When Dhirubhai Ambani died, the family business needed to be passed on to his 2 sons. Mukesh, the elder brother, graduated from the Institute of Chemical Technology, enrolled at Stanford Business School, then dropped out to help his father run Reliance. Anil, 2 years younger, got an MBA from Wharton. When Dhirubhai was alive, the 2 sons worked well together. But after his death, they battled fiercely for control of the company. After 3 years of fighting, their mother brokered a peace accord, which she announced in June of 2005. Each brother would get half of the company. Anil got Reliance Group, including newer businesses like Reliance Energy, Reliance Infocom, and Reliance Capital. Mukesh took Reliance Industries, which included oil refining, retail, and petrochemicals. At the time of the split, Mukesh was the third richest man in India, with a net worth of $7 billion. His younger brother was right behind him at number 4, worth $5.5 billion. From this point on, we will only follow Mukesh. Anil squandered his inheritance. In February of 2020, Anil declared before a UK court that he was bankrupt, with assets of $82 million and liabilities north of $300 million. Although many don't believe he's as poor as he claims, it illustrates how far he's fallen. Mukesh continued to expand and execute. If you're enjoying the video so far, hit like, make sure you subscribe. Now, before we go any further, I need to explain another quirk of the Indian economy. By most metrics, India rates as a relatively low-trust society. In a low-trust country, vertical integration makes sense because it's better to control an entire supply chain than run the risk that a competing oligarch will monopolize a key industry. Various international surveys, like the World Values Survey and the Edelman Trust Barometer, often measure trust levels across different countries. Public trust can be measured for institutions, businesses, NGOs, and media. India scores low across the board. That makes building brands especially difficult. In lower trust societies, personal relations and familial ties are more highly valued. In modern history, when a company can break through and earn the trust of the Indian consumer, they will usually expand into additional industries to translate that trust to more businesses. Another Indian conglomerate, Tata Group, has done this extremely well. In our video on Tata, one of the most common comments underneath is Tata equals trust. Reliance has been working to build a similar brand with the Indian consumer. In India, there is very little formalized retail, meaning instead of Walmarts and Targets and Costco's, there's more than 12 million Kiranas. This preference is representative of the low trust norms of the Indian economy. These mom and pop shops thrive on personal relationships and trust built over years with their customers. Shoppers often rely on these stores for credit facilities, a practice rooted in mutual trust, which large, formal retailers typically do not offer. Kiranas make up the vast majority of India's $932 billion retail economy. The exception is Reliance Retail. Founded in 2006, it is the largest retailer in India in terms of revenue. Its retail outlets offer food, groceries, apparel, footwear, toys, home improvement products, electronic goods, and farm implements. As of 2023, it had over 245,000 employees at 18,000 store locations in more than 7,000 towns. And recently, investors valued the business at $100 billion. Despite the size of Reliance Retail, estimates suggest that only 1% of Indian grocery is formalized. This is an enormous opportunity for Reliance. In formalized grocery stores, an enormous part of the business is private label products. These are items that are sourced by the grocery store themselves and marketed under a brand that the retailer controls. Because there's no middleman between the supplier and retailer, prices for private label products can be lower for consumers while simultaneously offering better margins for the grocery store. In a low-trust retailing environment, the opportunity for private labels is enormous. If Reliance has already earned your trust for sourcing fruits and vegetables, the likelihood that you'd buy their private label meat, dairy, beverages, and canned goods is great. Reliance is actively investing in the growth of its retail segment and sits poised to ride a wave of growth for the Indian consumer. Indian GDP currently sits at less than $2,500 per person. If that were to rise even to just $4,000, you can be sure that household budgets would have more to spend on food. To get an idea of what's next for Reliance, we can look at 3 distinct paths. First is the energy business. It is currently buried within a complicated conglomerate. Reliance leadership has suggested that in the not too distant future, the oil and gas division would be spun out as a pure-play energy firm. This would open the door for strategic investors like Aramco and Exxon to join the cap table, invest, and accelerate growth. Second, Reliance could take a larger role investing in Indian startups. The Saudis already do this through their sovereign wealth fund and through SoftBank's vision funds. It's gotten them into compelling investments like Uber and DoorDash. But the top funders of Indian unicorns are foreign companies. Alibaba, SoftBank, Tencent, and Sequoia's Indian fund top the list. Reliance could take the cash flows from its established businesses and plow those back into India's startup ecosystem. Like SoftBank, it could even raise money from other institutions to follow that investment thesis. But the third path might be the most compelling. Ambani has bet big, like $32 billion big, on the Jio data network that has brought hundreds of millions of Indians online. We made an entire separate video about that business that you can go watch right now.